I don't know how this isn't getting more press, but the housing bill is finally, really, in real life, official. The 21st Century Road to Housing Act became law on July 11th. After months of bipartisan collaboration, a dramatic canceled signing, a voter ID standoff, and a news cycle that has mostly just moved on without it, it became law. I've been talking your ear off about this bill since March. And I told you it wasn't going to fix the housing crisis, but I do think people who've been following this story deserve to mark the moment. 30 years of trying to pass meaningful federal housing legislation. It finally happened in the middle of a war, in the middle of a rate crisis, in the middle of the most chaotic political environment any of us have ever worked through. So we'll take the W. Bill does several things worth understanding before anyone tells you that it's going to fix housing altogether. Grants and forgivable loans for home repair and preservation, easier pathways for converting vacant commercial and office buildings into residential units, which is actually genuinely significant given how much dead commercial real estate is sitting in urban markets right now. There's also a suite of zoning reform incentives designed to encourage local governments to cooperate with and allow for more density. What it doesn't do? Address the construction labor shortage. It doesn't fund lower cost single family development at scale, so it doesn't meaningfully touch the 4 to 5 million housing unit deficit that has been building since 2008. This structural problem is decades in the making, so the bill is a meaningful step in the right direction, but it's far from the destination. The real impact, whatever that may be, will be felt in 18 to 36 months as projects get funded and projects get permitted. Which means buyers in today's market cannot wait for this bill to save them. They cannot factor it into their strategy. But buyers in 2028 might be dealing with a different set of circumstances as a result of this bill. We also got quite the plot twist this week with CPI. The June numbers were released Tuesday morning with the best inflation print in over a year. The Consumer Price Index fell 0.4% for the month, the steepest monthly decline since April of 2020, driven by a 5.7% drop in energy costs. So, the war created bad inflation readings, but then when you look at month-over-month improvements, it gave the market something to celebrate. The annual inflation rate came in at 3.5%, which was down sharply from 4.2% in May. Economists had been predicting a drop of only 0.2% on the month and an annual rate of 3.8%, so we beat both by a lot. Core inflation, which strips out food and energy, was flat month over month, so again, telling us that the war is creating the problem and then also solving the problem. Core was flat on the month, putting the 12-month rate at 2.6%. The consensus forecast was at 2.9%, so again, better than expected. The market's reaction was immediate. The 2-year Treasury fell more than 7 basis points, the 10-year yield declined more than 2 basis points, the S&P 500 gained 0.47%, and the NASDAQ rose over 1%. Market pricing for rate cuts in the second half of 2026 actually increased following this news. So there has been speculation that the hot May inflation readings were the peak of what was going to happen as a result of the war, and these June numbers support that thesis. The energy shock from the Iran conflict drove inflation to 4.2% in May, oil prices came down in June, and now we're seeing a reversal show up in the data exactly the way the timeline suggested it would. The market likes that. It likes predictability. Of course, there's a caveat or two. Core shelter inflation remained elevated despite the headline miss. The Fed watches service prices carefully, and they're not done worrying. And the ceasefire collapsed. So oil is currently climbing back towards $80 a barrel, which means the July CPI print could tell us a whole different story, right? We could see a little bit of this. The August CPI, that number will come out on August 12th. So that's your next data milestone to watch for in terms of inflation. But for one Tuesday morning in July, the data gave us exactly what we needed for some relief on mortgage interest rates. Also this week, Warsh testified or appeared before Congress, the House Financial Services Committee. That was Tuesday morning, and then the Senate Banking Committee on Wednesday. This was his first congressional testimony as Fed chair. Here's what he said and why it matters for mortgage interest rates on a couple different points. On inflation, he said the inflation surge of the last 5 years will be a thing of the past if the Fed gets monetary policy right. He called inflation a tax on the American people. No shit, Sherlock. On forward guidance isn't the business we should be in. He is not going to tell you where rates are going. He's going to look at the data and move accordingly. In my opinion, that might be logical, but it makes the market uncomfortable because that's not the norm. We usually see the Fed chair's dot plot. On task forces, the 5 teams reviewing Fed communications, the balance sheet, economic data, labor market analysis, and inflation frameworks, they will share their findings with the 19 FOMC members first, and then Warsh will present publicly. Any changes to the $6.7 trillion balance sheet will be telegraphed to the markets before they happen. Interesting, right? On pressure from the president, the lawmakers pressed him directly on whether he would resist political interference, and to give the guy credit, he did not flinch. The Fed chair, who was supposed to deliver rate cuts for the president, walked into Congress and instead delivered a price stability sermon. On AI, he pointed to the ongoing infrastructure build-out as a powerful economic force, but acknowledged that the impact remains uncertain. This matters because one of the variables that could actually help productivity and bring down inflation structurally. But he's right, the timeline on that happening is unclear. The market initially rallied on the good CPI print Tuesday morning, but then gave back some of its gains because Warsh's testimony was over here and then over there. And it reminded everyone that one good inflation reading does not change the Fed's posture. They're still data dependent, still watching core services, and still not promising anything. Then, this morning's housing starts report was actually the second best surprise of the week, behind CPI. Housing starts surged 19% in June to an annualized rate of 1.43 million, the highest since March and well above the consensus estimate of 1.3 million. This is a massive beat coming off of May's numbers, which were the lowest ones we'd seen since 2020. Single-family housing starts came in at 895,000, which was essentially flat with May's revised figure of 897,000. So the surge was driven almost entirely by multifamily, apartments and condos, which rebounded sharply from last month, which last month was a historic drop. Here's the nuance that I think is worth paying attention to. Building permits fell 3% to 1.37 million, below the 1.4 million consensus and 2.3% below June of last year's numbers. Permits are a leading indicator, guys. They tell you what builders plan to build in the coming months. So the fact that starts surged but permits fell suggests builders are completing the projects that they already started, but they're hesitating on committing to anything new, to starting a new project. I'm not trying to be pessimistic, just honest. Builders are cautious with interest rates at 6.5% and an ongoing war. That might be why they're cautious to start any new projects. But that also is not good for the imbalance we have with supply and demand. So what does this all mean right now? Realtor.com mid-year forecast expects rates to fall to 6.3% from the current of 6.6% on average. That is 30 basis points. So, for example, on a $420,000 loan, that's roughly $80 a month. It is also half the improvement needed to unlock 2.5 million additional potential buyers into this market. We already talked about what happens then, and I just explained how the supply problem is unlikely to be solved quickly. Sellers and buyers out there need to consider this information when they're figuring out their personal plans and their next best step.